Afternoon, everybody. Thanks for stopping by. We'll, of course, be making forward-looking statements, which somehow got left out of the deck. Oops. I think it's at the end. So I'll just start with some highlights. We're a production story and we don't need any more capital. We're fully capitalized. Your counter's not working, by the way. Just I could let that just stay there. But so we found a 1 million ounce deposit, 8 grams per ton open pit. It's one of the highest grade open pit gold mines in the world. We partnered with Kinross to take advantage of their underutilized mill at Fort Knox to process our ore. So we will be in production, we're actually mining now, we'll be in production by the end of next quarter, so probably May, June timeframe, and we should be seeing, once the working capital fund is up and running, we should be seeing dividend checks in probably July of this year. So we're fully financed. We're working on lands that are owned by the Tetlin tribe. I'm from Alaska, I grew up there, so it's an area we know well. We've been working with the tribe since 2008. They want this mine in production yesterday. They'll receive a nice, handsome royalty. Again, we're pretty much all lined up to do business. You can see the map there, the photograph shows where the mine is located on top of a hill. So from a mining standpoint, it's in a good location, minimal amount of water. It only took us a little over a year to permit because we didn't permit a tailings facility and a mill. We just permitted a quarry operation, so fairly simple. By taking advantage of the mill at Fort Knox and the tailings facility at Fort Knox, we probably saved ourselves $600 million of capital and probably 5 to 10 years of permitting timeline. So location-wise, the gold star next to the Yukon border is the location of the Manh Choh project. As I said, it's the joint venture with Kinross, and we're mining now and stockpiling and transporting the ore up to the mill, which is where the red star is located just outside of Fairbanks, along the Alaska Highway. It's about 240-mile drive on a paved highway. And in terms of gold, it costs about 1.2, 1.3 grams to pay for the truck ride. The other gold star there is our Lucky Shot project. It's the only other, we have several other early stage projects in the state, but I'll forego any discussion of those and just focus the other part of the talk on Lucky Shot, where we want to do the same thing. We have a high grade resource identified there. We're going to expand that out to 400,000 or 500,000 ounces and do the same thing that we've done with Manh Choh, take advantage of the Fort Knox mill and build our gold production level. So I'll talk to you about that. Quickly on our share capital structure, we're a New York Stock Exchange listed company. We're not a Canadian company. We're not listed in Canada. We have, at last count, $16 million of cash and $40 million of debt borrowed from ING Macquarie debt facility of $65 million. You can see our shareholder base, management and the board are very strongly supportive of this company. I own about 7% of the company. So we're all in, if you will. Our mine opening occurred in July of last year, basically 1 quarter ahead of schedule. The governor of Alaska was there, Chief Michael Sam in the middle were there, along with the rest of the Tetlin Tribal Council. And it was great to see the mine open itself. It's an open pit mine, pretty typical truck and shovel operation. Kiewit is our mine contractor. Black Gold Trucking is the transport contractor, a local Alaska contractor. It's been in business for quite a long time. These are basically double haul trailers that go on the highway. It's side dumps, and they dump the ore at the Fort Knox mill laydown area. So this is all happening. It's been happening since July, building the stockpile up at Fort Knox and for processing, probably, as I said, probably in the end of the next quarter. Now, our grade is 10 grams per ton. Our grade is 8 grams per ton, which is 10 times the average grade of Fort Knox mill grade, which is somewhere between 0.6 and 0.8 is what it averages. So you need a lot more capacity for cyanide, a lot more capacity for carbon, cyanide destruct circuit. All that needs to be built up, which is basically just tanks and piping. It's nothing different in the process flow sheet, you just need more capacity because you have a lot more gold going through the system because of 8 grams per ton versus 0.8. That work is being done now. The laydown area is complete. The tailings pipeline is complete into the bottom of the Fort Knox pit, which is fully permitted for disposal of the tailings. We have a joint venture meeting in about 2 weeks. I'll get an update on mill modifications, but their schedule was to have those done by the end of March, and start going through the ramp-up process of making sure that the new tanks and piping are all integrated into the existing circuit. We're basically spent all the capital now on the mine. The mill modification capital is spent by Fort Knox, and then we pay a toll to Fort Knox. We, the joint venture, pay a toll to Fort Knox for the processing. Basically, we're just spending working capital now, and it's been between about $4 and $5 million a month to basically pay for the mining and the truck ride up to Fort Knox. Our all-in sustaining costs about $1,116, and because everything we do is contracted, the mining is contracted with Kiewit, the truck haul is contracted with Black Gold Trucking, and of course the processing is contracted with Fort Knox. There's not a lot of room for increases in prices. Those have all been actually come in under the feasibility estimate. So I think we're in pretty good shape in terms of our costs. So next step is just pouring gold. In fact, they need to get a bigger furnace to pour the gold because we're going to produce more gold in that month than they do in the other 3 quarters of when they run Fort Knox ore. This is from the feasibility study. We went up to a gold price of $1,920, but you can see we're going to make well over $50 million of free cash flow for our 67,500 ounces of gold on average per year. We've hedged about 40% of our total gold production at 2025. So I guess the gold price went up nice today, but it was kind of right in there at the current gold price. That protects the bottom, the downside. And obviously with the bank loans, the banks will force you to hedge, but we still have 60% exposure to the upside. So we should be better numbers than what are shown in this 1920 guidance here from the feasibility study. Lots of exploration upside on the project. The Tetlin lands are private lands owned by the tribe. They're about 675,000 acres, so it's a big block of land. It's, again, private land. We've only explored a very small percentage of it. This map here represents what we call the Chief Danny area, or Chief Danny zone. That represents about maybe 5-6% of the land package. We have a lot of data there, a lot of geochem, geophysics, so we know where the trend of the mineralization lies, and we just need to drill along the trend. I'm confident we'll find more ore. Typically we have a 4.5-year mine life right now, but I don't think we'll be stopping there anytime soon. So I think we'll be successful. We got a $4.7 million program this summer, which will probably get going in May, June of this year. So expect some drill results from that. Now, kind of backing off and looking at our other assets, I mentioned the 3 early stage assets. We have 2 north and northwest of the Manh Choh project. Those are 100% owned by Contango, and our Shamrock property, located not too far from the Pogo mine, right along the highway there. The early stage, we'll be exploring them, but what I want to spend a bit more time on is Lucky Shot. In the red circle here. It's about a 2-hour drive outside of Anchorage. You can drive a minivan right up to the portal. Very, very accessible. And then the other thing is we have the rail line between Anchorage and Fairbanks to take advantage of as well. So rail is about 1/3 the cost of versus trucking. So keep that in mind. Now, Lucky Shot was a mine that was in production from 1928 to about 1942. Produced 250,000 ounces of gold, averaging 40 grams per ton from underground mine. Now it was selectively mined and high graded like they would do back in the day. We're looking at a mine plan that'd be about a 3 meter minimum mining width and a grade that's going to average in the neighborhood of 15 grams per ton. You can see the main tunnel there at Lucky Shot. That's where most of the production came from. The insert tunnel is a tunnel that we've recently refurbished and put in all the way back to the ore body underneath the mountain. This is kind of a perspective diagram. You can see there's a lot of drilling on the Coleman segment of the vein from surface, and we've outlined about 100,000 ounces there at just shy of 15 grams. And then if you look over at the Lucky Shot, the gray area there, the darker gray, is the historically mined Lucky Shot vein, where they produced about 250,000 ounces at 40 grams, again, selectively mined. We drilled pilot holes down below that. We know the vein structure exists. Like the previous speaker, you just have to drill the heck out of these things. So we're underground, drilling that zone, and we've got a little more drilling to do from the surface to follow the high-grade zone down plunge down to the level of the Lucky Shot vein adit, which I'll show you here in perspective. So we did the surface drilling from the top of the mountain. It's steep up there, so you got to have a nice cribbed up drill pad. That drilling is to project, drill down dip from the projection of the high-grade zone that's running about 15 grams per ton, and then drill it down to the Lucky Shot level. This view is looking north now. You can see where the two fan drill shots there, that outlines about 10,000 ounces at Lucky Shot. We've only done a little bit of drilling. We've done the pilot holes, so we know that the structure's there. The plan is to do infill drilling, and we think we'll outline about 250,000 ounces at the Lucky Shot, and then about another 150 over at the Coleman. So this is the underground drilling at Lucky Shot. It's about 10,000 meters of drilling, and then there's about 3,000 meters of surface drilling to do. So it'll be a drill-intensive program. We think we can start this mine at about 30,000 to 40,000 ounces of level of production. We're fully permitted. We don't need any more permits to mine, put rocks in a box, and haul them up to the Fort Knox mill, either by truck and rail. So that's the plan. That's what we're going to outline. Just spending a couple of minutes on the Lassonde curve. This was Pierre's Lassonde curve back in 1990 when he published it. We know the excitement of discovery and then the hard valley of death there that you have to go through to get a mine into production. The difference between 1980, 1990 when he published this and now is that the valley of death is not 2 to 3 years, it's 10 plus years. So with our cash flow, we plan to look around at the neighborhood in North America and look for opportunities where direct shipping ore is a possibility to a mill, an existing mill and a tailings facility, avoiding the capital of building your own and avoiding the permitting timelines to permit a tailings facility. In North America, that's going to take at least 5 years. And if anybody tells you they can do it sooner, they're probably BSing you. That's just what it takes. But we'll have cash flow, and we can take advantage of the kind of market that we're in for now, where we have access to capital that most other companies don't. So happy to answer some questions if we've got time. Thanks.
Great. Thank you very much.